Good morning and welcome this morning to Managing an Options Portfolio, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend and 20 plus year veteran of the financial markets, which meant that she started when she was about 8 years old. Connie Hill, she's going to be out there to facilitate the conversation, keep things going. If you're in the live version, welcome to you and be a part of that conversation by chatting in your questions. If you are in the recorded version, we're glad to have you with us as well. Leave us a comment in the comment section. And I'm glad to have the opportunity to sit in on this particular webcast for my good friend Brent Morris, who normally teaches this particular session, because it's an opportunity for me to kind of clean out the closet, if you will, of my options positions that I've got in my portfolio. And if you're like me, as I suspect many of you are, you have a tendency to leave options positions sitting around. I do because I teach a lot of different things. I teach a lot of different things in a lot of different venues and for a lot of different reasons. And so maybe I have a greater proclivity to leaving options positions sitting around to just kind of waste away in my portfolio, despite my best intentions to manage those positions on an ongoing basis. So, like I said, if you're like me, then maybe this particular webcast is something of interest to you in terms of managing positions that have just been kind of sitting there collecting dust, if you will, in a metaphorical way. So let's get into the couple of quick housekeeping items as we start this discussion. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or solicitation or advice. When you talk about trading options, remember that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks. Standardize options before considering any option strategy. A couple of things to pay attention to. We're going to be using the Thinkorswim desktop software platform today. Specifically, the paper money version of that platform. Now, the paper money version is a great sandbox to practice in, but there's a moral hazard to that because, number one, it's not a guarantee of future success out there in the real world. And number two, if all of your practice is in paper money doesn't do certain things. It doesn't facilitate the early assignment of short options. So you can get in the habit of just leaving options to go in the money close to expiration and assume, well, it's never happened to me before that I've been assigned early, so it's never going to happen to me when I go out into the live market. So I'm just going to behave the same way. And then you find that the reality is different. Number two, order fill prices are going to be different in paper money. They're going to behave differently in paper money than they do in a live account because paper money fills algorithmically at the midpoint. Live money is going to fill orders based on what the market is doing. So just be aware of that. Again, remember, past performance, no guarantee of future results. And technical analysis, probability analysis, fundamental analysis, all of those are theoretical in nature. None of those are guarantees as to what a market may do or an individual symbol. And so don't rely on any one of those for your investment research. Let's jump out here really quickly to the Thinkorswim desktop software platform and kind of get into the idea here. So, like I said, I teach in a variety of different locations. I teach in live workshop events. Some of you have seen me out there on the road. Some of you have been to those events. Some of you are likely to go to those events at some point. So I teach and use a lot of different strategies in those events, both the technical analysis option strategies, as well as the advanced option strategies workshop, as well as the market drive event. And all of those three different types of events have different types of trades that we're demonstrating. So I get a bunch of stuff accumulating for those. I also teach live and virtual branch events in our Schwab branch network. And so those events require different symbols. I also teach in different types of trade strategies. I also teach a couple of different webcasts on a regular basis. I teach trading futures on Tuesday mornings, and I teach trading index options on Wednesday afternoons, coming up in a couple of hours from now. And then I fill in on a lot of other webcasts. So I tend to collect a lot of stuff. So what I did this morning is I just kind of scraped together into this long options group in my portfolio a bunch of positions that have just kind of been sitting around. I've got other options positions, but this is now a group, if you will, kind of an ad hoc watch list of positions. Now, I will say this, these are not all long options, but I've been filling in for Rachel, so I had to build that group for long options. So taking a look at some of these positions, there are a couple of pieces of information. So I don't know about you. This is the process that I go through every so often. And maybe you do this as well. As you start to look at these positions, you think, why did I put that trade on there? What's going on with this trade? So you kind of have to go through and kind of make some assessments about what's happening. So I wanted to just kind of show you through my process. And so here's one of those times, this particular webcast, where you get to join me on kind of a personal journey, if you will, and kind of peek over my shoulder as we do this. And so we'll talk through some of these ideas. Please feel free to chat your questions in, and I'll try to incorporate those into the discussion. If not, Connie will try to help me to answer those questions as well. So I'm looking at this group of options, positions, and I notice a couple of things right off the bat. Number one, I noticed that these are arranged alphabetically, which may or may not be the best way to have these arranged in terms of the precedent of the priority, if you will, of how I should manage these positions. So the first thing that I'm going to do in this particular display, and I've got this in a group, is I'm going to arrange this in maybe something that's a little bit more functional, at least in terms of what requires my priority, or what maybe ought to require my priority for managing first. So the first thing I'm going to do is I'm going to sort this list of symbols, not alphabetically, but I'm going to come over here and I'm going to sort this list of symbols because I don't know how many days any of these positions have to go. I know that all of these that are flagged with that ITM flag or in the money flag are going to be within 7 days of expiration. That's just a given. That's the way that the platform is set up. You can change that, and I'll show you how to do that here in just a moment. But maybe we take the first step as being what's winning and what's losing, right? What trade is working for me and what trades are working against me. So I'm going to come over here to the P&L open column. So this is profit and loss since the position was initiated. I've got P&L day. Now, P&L day is since yesterday. Yesterday's close, right? So now I'm going to just sort this list first and foremost. This is kind of the first listing of how we're going to sort this. I'm going to sort this by P&L, profit and loss, since the open of the trade. So I can see what's hurting me, what's helping me. And if I sort that list by P&L open, I'm going to put the biggest loser, and I don't, that sounds really negative, but the trade that has the most negative P&L at the top of this list, and the one that has the highest P&L, which is surprising to me, to be honest, in looking through this position, that Nike has the highest profit and loss since the initiation of the position, and GE Vernova, which is an energy stock, which is an AI energy stock primarily, has the biggest P&L loss. But that's okay. I'm not going to judge this. I don't know the reasons, to be honest, why I put these particular positions on. All I know that is that at this particular moment in time, the trade that's hurting me the most is this GEV trade, and the trade that's helping me the most so far over the course of this time frame is this one right here, Nike. Okay, cool. So I now have one particular position, kind of way to view this in terms of prioritization. So why do I use profit and loss percentage? To be honest, Eric, I don't necessarily use that profit and loss percentage, but that is a way to measure the performance or effectiveness of a particular position. Now, you notice that some of these that have a greater potential or profit and loss percentage or loss percentage, gain percentage, are not the highest dollar value P&Ls. So it's just a column that you can add. All of this is customizable. If I come over to the right-hand side, this right-hand corner, I can customize all of those columns that I'm displaying in this position, with the exception of P&L open and P&L day. So Those are going to be constants throughout this monitor tab, activity and positions, position statement page on that monitor tab, right? So I'm going to have P&L open P&L day regardless. The rest of them, I'm free to make those changes. So if you don't want to use P&L percentage, you can take P&L percentage out. You can take it out. And I'm just going to take that from that standpoint and leave that in that position. Now, I'm going to also put in here delta, theta, vega, the option Greeks, so that I can see the performance of those individual positions on a sensitivity standpoint, if you will. But let's take this first trade. The first thing I'm going to do is I'm going to look at the one that's hurting me the most, right? And say, wow, that's going to be the one that is causing me the most account damage, if you will, right? And to Connie's point, that's certainly something too that you could do is sort the trades by P&L percentage. And I get pretty close, but I notice that, it puts a priority on something different. The priority on something different is that it prioritizes Disney as opposed to GEV. So I'm going to go back to GEV. We're going to open up this position and we're going to see what this position is doing and what I've got in this particular case. So what I've got here, and one of the reasons why it's doing what it's doing in terms of that impact is I have a couple of different positions in here. I have a long put, and at the same time, I have a long call. And so what that tells me is I've got two oppositional forces going on here. I've got a directionally bearish trade that's close to expiration. I've got a directionally bullish trade, which is getting closer to expiration. And I probably put these on at two different times and kind of scraped all these together. And so I've got contrasting purposes. And this is a good way, a good reason for doing this on a fairly regular basis, kind of going through this maintenance process to see what you've got going on. Because you might at some point recognize, hey, I've either got an embedded vertical spread or I've got counter purposes going on here. I've got a long put and a long call. And they're both moving, they're both moving and they're doing something. But they're both, in this particular case, working against me because time decay is kind of killing me here. In fact, if I were to look at the theta on this trade, that long put option and that long call option, both are just whacking me on theta, time decay. And the closer we get to expiration, the greater that time decay component is going theoretically, right? So I'm going to go to the chart really quickly, and I'm just going to bring up my single grid chart, and I'm going to put on GEV just so that I can make sure that I've got an understanding of what my directional opinion might be, what my directional perspective is. So looking at this particular chart of GEV, still bullish, but in the short term, I've been slightly bearish. I've got a divergence or maybe an acceleration, an acceleration of downward momentum. Momentum is bleeding off as price is maintaining roughly equal lows, if you will. I've got lower lows on RSI. So this is becoming a little bit more bearish, possibly, or a little bit more sideways. And in this particular case, I've got implied volatility that was higher, probably when I put some of these trades on, and is now moving lower. It's kind of right in the middle of the pack. In fact, if I were to look at this, where this 52% implied volatility is relative to where implied volatility has been, this is probably about in the 40th or 50th percentile. So how do I know? Well, I'm going to go to the trade tab really quickly for just a second. And this is just going to be a check that I'm going to make here to see where that level of implied volatility is. I'm going to go to today's option statistics, and I'm going to look at current implied volatility percentile. That's putting the current level of implied volatility in a range of where the highest it's been and where the lowest it's been has been. And so now I'm coming out at about the 47th percentile, kind of right in the middle. So if implied volatility goes up, that could help me because these are long options. If implied volatility goes down, that could hurt me because these are both long options. I probably did, Jay Taylor. Yeah, absolutely. I think I probably did add that at the Boston event. You're very likely correct in that particular case because we talked a bit about that, about GE Vernova. And by the way, These guys are based in Cambridge, which I know is not Boston, but it's right down the road there from Boston. So yeah, that's probably why we put that particular trade on. So relatively neutral perspective directionally. Implied volatility is kind of right in the middle. So now what do I do? Well, the first thing we've got to do is we've got to come back to the monitor tab and we've got to take a look at this position. Now, clearly, when we talk about priorities, the next level of priority after seeing that the overall position here is whacking us to the tune of about 6 grand since we put the trade on, and it's really hurting us in terms of overall theta, is we need to see which one is the most important time-wise. Now that we've got money figured out, now we got to figure out what's the most important, or maybe the most, what we might call the most urgent priority in this particular case. And it's this long put. This long put, which is the right to sell the stock to somebody else at a later date at a certain price, at that strike price. That long put option, which gives us the right to buy this or to sell the stock at $990 a share, is something that we need to deal with because it's only got 2 days to go until expiration. Stock's currently trading at 1,071. So this option is well out of the money at this particular point, at 990 put. That where that could come into play is if in the next 2 days, catastrophically, the price of the stock could go down significantly. In which case that option would gain potentially some value, or at least give us the opportunity to sell the stock at 990 if the price of the stock were, or the price of the underlying stock were at or below 990. But all we've got remaining is about $18 or about $1.82, $18 if we were to convert that into the times 100 shares component of that, right? So we've got about 18 bucks remaining in this trade. It's done any hedging activity that it can do for us because it's only got 2 days to go. So what I'm going to do, and since we left this sitting here, I'm just going to salvage, because that's still pulling theta away, right? And that's still decaying away. It's done some damage. We're going to salvage what we can salvage out of this. So I'm going to close this one down. And I'm going to right click. And I'm going to create a closing order. Now, I could look at rolling it, but until I deal with the other side, I'm not going to necessarily look at rolling. So for this point, I'm going to simply, remember, rolling is not a magic wand. Rolling is simply closing one and opening another one. So I'm just going to close this one down in this particular case, confirm and send, read through the order, make sure that it's to close, make sure that this is what I want to do. And I'm going to take this trade off so that it's no longer able to do even that $18 of damage that it's currently sitting at. So I'm going to click on, or I'm sorry, $180 worth of damage. Excuse me. I should have times that by 100, not 10. There we go. So now that's done and that's out of there. And by the way, this is a good process to kind of go through in thinking about getting in the habit of closing trades down positively prior to expiration. Could I just let that go? It's out of the money. Yeah, I could have let it go. It's going to expire worthless, but then I'd lose another 180 bucks. At least in this particular case, I was able to salvage that. And at the very least, not realize the entire amount of damage. And that's the one that really hurt me, was that long put option. Because now my P&L open has gone down from 6 grand to 1,400. This one, which has more days to go, the long call option, which gives me the right to buy the underlying stock at that strike price, with that expectation that the price of the underlying stock is going to go higher. I've got the right to buy the stock at 1,050. Now let's go back to the chart just quickly. We're at 1,071. So this is an in the money. This is an in the money call option. So I could, and it's got some it's got a little bit of intrinsic. It's got what? $21 of intrinsic value in this particular case. So it still has some extrinsic value here. So remember we talked about this idea, and we've had this discussion before. I'm just going to draw this on the chart, and I'll answer Charles's question here as we go through this. So remember this chart that we take a look at when we talk about things like time decay? And this is profit and loss. And this is time to go until, I'm sorry, this is not profit and loss. That is option price. Okay. So as we get closer to expiration, the rate of time decay accelerates and gets bigger, and we lose money faster and faster out of the trade. We talked about the idea of being the buyer of an option out here. I'm just going to put this on buyer. And we talked about the idea of selling that option back when it gets to the edge of that curve where it starts to accelerate off the edge of the curve. So we talk about this kind of in, and we put some general numbers. These are not rules of thumb. These are not absolutes. These are just considerations. 50 to 150 days worth of time is oftentimes where option buyers, long option buyers, will begin that journey out in that 50 to 150 days worth of time. And then thinking about when to sell, when that starts to fall off the edge of the cliff, is somewhere generally in the 40 to 20 days to go until expiration range. So we're right here on that short end of that range. We're at 23 days to go until expiration. So here's the problem, though. This assumes either neutral direction, or it assumes that the price of the stock has moved in the direction that we wanted it to go to begin with. Well, the direction that we wanted this stock to go to begin with was up. So when we put the trade on, to Jay Taylor's point, we probably put this trade on with that expectation that it was going to go higher in the short to intermediate term, which it was doing. In fact, we got in that breakout there at the Boston workshop, and it went up on the earnings announcement, and then implied volatility came down, and now the price of the stock has kind of come back down again. So price has been relatively neutral, but the thing that has not been neutral, the challenge, the process that has not been neutral here, is the inevitable passage of time. So a trade that we paid $82 a share for, times 100 shares, is now trading at $67 a share times 100 shares. And we've got 23 days to go until expiration. So let me just ask you the question. Let me just throw this question out to you. 23 days to go until expiration. The price of the stock has been pulling back. It's still in an uptrend longer term, but it's got a bit of a bearish divergence RSI wise. Implied volatility is kind of right in the middle. We're post the earnings announcement. What do you think? Do we hold on longer in expectation that the price of the stock is going to go up? Do we sell it and get out of the trade and then look for another entry opportunity? Or do we roll it to maybe another in the money option and continue our expectation of the price of the stock? So those are the choices that I want you to answer. Buy it, or excuse me, sell it back, leave it, or roll it. Sell it, leave it, or roll it. And Tim says roll it. Okay? All right? Cool. Roll means buy it back, or excuse me, sell it back and then buy another one. Either the same strike, different expiration. Just do it in one transaction. That's the only benefit that a roll gives us, is it's convenient. It's not a guarantee. It's not a magic wand. It doesn't reduce fees. It doesn't do anything else except allows it. So Bogus says sell it. What is the loss to close it out? Well, the loss to close it out is going to be about $1,000, maybe $1,300. Right? We bought it for 82. We'd be selling it for around 69. That's where our loss is. Sometimes it's okay to take a loss. If this trade has not done what we expected it to do, we're now at that point where time decay is going to be fighting against us more rapidly than any directional movement can really recover from. And the closer we get to expiration, the more exacerbated that challenge is going to be. Right? So Jay Berg asks a question: probability to turn the loss around? I don't know. We got 23 days left, so there's fewer and fewer days. I'm guessing that this particular trade probably has, when we talk about, oh, it's got about a 59-cent delta. So it's still got some directional sensitivity. CB says, can you roll it for a credit? Otherwise, sell. No, we're not going to be able to roll this one for a credit. It's going to be cost out of pocket. All right. Cool. It's going to be cost out of pocket if we were to roll it. And I'll tell you what my preference is given this circumstance. And coming back here to a technical analysis standpoint, if I were going to roll to a deeper in the money call, right, or to a similar strike price, and we're at the 1,050 strike. 1,050 strike is going to be right about here off of that level of support. You know what? That's fine if I had an expectation that the price of the stock were going to break maybe that diagonal trend line, maybe it were to give me a close above the high of the low day. Now, Tim says if you still believe that the stock is bullish, then roll it. Okay, all right. Because rolling it is still, at this point, I'm going to be adding a little bit to the cost of this trade. I'm rolling it here at this point without clear confirmation of the price of the stock in the short term still moving higher. So I could roll this out to that same strike. Let's just explore that really quickly. Let's go back to the monitor tab and let's go to this option, rolling it, creating a rolling order. Now, the Thinkorswim platform assumes a roll to the next available expiration, which is rolling from the 5 June to the 12 June expiration. That buys me another week, basically, right? All right, so what I'm going to do is I'm going to look out actually at my option chain here before I accomplish this roll. And I'm going to say, all right, here's where I'm got the 5 June expiration, rolling to the 12 June. I'm going to maybe roll, see what might happen if I roll back here to the maybe 17 July. So let's see what that ends up costing me if I roll to the 17 July. So it adds another 3,700 bucks. So I'd better, it slows down time decay, but I'd better have a pretty solid expectation of directional upward movement in order to accomplish that roll, right? In order to not necessarily justify, but in order to really kind of validate the idea of staying long the call option here in this particular case. So if I didn't have, look, if I had a break above this resistance level, one, those call options are probably going to be a little more expensive anyway. But that might give me more justification than the price, in the price of the stock staying bullish. So I will tell you this. I'm going to do this. I'm going to accomplish the roll just so that we can demonstrate it. But I think there's probably an equal case to be made for simply selling it back and waiting for another opportunity to enter as there is to create the roll out to that weekly option. So I'm going to go ahead and keep that roll. Yeah, and that's a pretty, that's adding a pretty juicy, hefty premium. But that being said, we're adding duration to this trade for roughly less. I mean, not necessarily less, but less overall than if we were to put on two separate trades at the same time, right? So rolling for a debit, and when we talk about rolling for a debit or rolling for a credit, this is maybe one of those exceptions, Mighty Mouse, because this is a long option that we're rolling out for duration, which we know we're probably not going to get as a credit. Now, ideally, we could if we were pulling some cash off and if this had worked in our favor. So I'm just going to demonstrate this, and you're right, roll it for a credit or just forget it. If this had gone up and now we were pulling a little bit of capital out of this, we were pulling a little bit of profit off of this table, then yeah, that maybe makes sense. What to do? All right, let's just do it. We'll put this out and we will roll this out to that long options. But I'm going to put a note. Roll based on opinion that GEV still bullish. Okay. So we're going to put that note in there and we're going to roll this out. Now, rolling again is going to depend on the liquidity of the target. So now what we've done is we've rolled that out. in time. And so if we come back and we look at that GEV position, now we are long the 65 days to go until expiration 150 or 1050 strike call option. So we still have that bullish expectation. So now we got a bigger break even to meet. It's got to be really bullish. Okay, that's okay. I'm okay with that. All right, now let's come back to the next trade here and kind of go through the same process. The next one on this list, and this is a little bit different perspective. This is FedEx, right? And FedEx, I'm already getting that in the money flag, and it's hitting me to the tune of about $915 since we opened the position. So I'm going to open this up, and this is a long call. And once again, this is a long call that's down at 2 days to go until expiration. This is withered away. It's worked against me in that directionally. Let's just take a look at the chart. FDX. FedEx has gone sideways. So when we get into the situation where the price of the stock's not doing what we expected it to do, there's not a lot of time remaining for it to do what we expected it to do. Perhaps sometimes the best thing to do is to simply exit that position. Yeah, you're absolutely right, Charles, for sure. So I'm just going to create a closing order. We're going to sell that one, get it off the books, put it in long options. We're going to get that off the books and redeploy that little bit of capital that we can recapture in this particular case someplace else. So taking that off the books, FedEx is now gone. Next one on the list is this Disney position. $100 put strike. Okay, so this is a long put option. 36 days to go until expiration. We bought it for $7.45. It's currently trading at $1.42. Let's go to the chart and take a look at Disney. So my guess is we bought this as a protective put. Okay. And Disney is starting to pull back a little bit. It rallied up, pulled back, rallied up, pulled back, broke out, gave us maybe that false breakout of this inverted head and shoulders pattern, and is now pulling back a little bit. We're post the earnings announcement, implied volatility is falling. Here's the thing. We go back to this particular trade. It's got 36 days remaining to go, and there's a possibility that the price of the stock, which is currently sitting at 104, could continue to go down. So this still has value. This position still has value, even though it's only lost. It's lost about $5, $6 in the trade. It still has value as a protective instrument because it gives me the right to sell the stock at 100. Is there still the possibility that Disney could go down below 100? It's currently sitting at 104. Yes, this still has some value as a protective instrument. So from this standpoint, I'm going to leave that. Now, I could consider rolling it out because those put options, although here's the thing, put options have gotten less expensive because implied volatility has gone down, but they've gotten more expensive because the price of the stock has come down. So rolling it means I'm going to be buying a little bit cheaper protection for a little bit more time. And remember, there are times to have hedges on and times not to have hedges on. Strongly uptrending market, strongly uptrending stock, probably not the time perhaps to always have a hedge on. But here we have a stock that's given us two kind of false breakouts here and then pulled back. We're post the earnings announcement, and we're coming down to a point where implied volatility is falling. I'm still going to leave this protective position in place because I think there's still a bit of bearishness, in my opinion, here in this particular case. So I'm going to leave Disney alone in this case. Now let's take a look at this next one, which is CVX. And this is where we are long to put, 2 days to go until expiration. It's done what it can do for us, but the same kind of thing. It's hurting us because it's getting close to expiration. Let's take a look at CVX. And CVX is still holding implied volatility going down, but it's still holding this horizontal trend line here. Now, it has some protective capabilities still, but it is trading. Price of the stock's at 184. This is trading at 185. It's an in-the-money put option. We could choose to sell the stock at 185. but we'd be sacrificing about $1.90, or excuse me, be sacrificing about 99 cents of extrinsic value in doing this. So this is one that I might consider doing a roll because implied volatility has gone down. So right click, create a rolling order. And in this particular case, this is when I'm going to maybe roll out to that that weekly or to that next monthly out, maybe out to that 17 July to keep that protection in place and speculate against that downward movement. So I'm going to look at the possibility of rolling this out. So I can sell this back, but I'm going to roll this out potentially to that 17 July. And if I roll this out to the 17 July, I'm really not only adding about another $3 to that debit in this trade. And again, opinion still somewhat bearish. It's holding that level of support, but it still has some protective capabilities. What if I roll it back? Let's go back to this 18 June and see what that looks like. $4.89. That's a little bit more palatable, and then we can make the decision. We're buying a little bit more duration and giving that opportunity to continue to move through this next little while as we have more geopolitical instability. So I'm going to go ahead, I'm going to click on that order, make sure that we know what we're doing. We're creating a roll. Again, remember, a roll is going to be dependent on the liquidity of the target. We're going to roll to the same strike here, and we're going to roll that out. All right. And that may take a minute to fill. All right. So let's take a look at the next one that we've got in the list here. We're going to roll that CVX out. There's our order to roll that. Next one on the list, I want to get to a short option here. Let's grab another one that's here on this list. FedEx, we moved. Walmart, we're long. Campbell's, we're long. Nike, we're long. I did have a short option right here in ExxonMobil. There we go. Okay. So I've got a long vertical spread here in this particular case on ExxonMobil. I'm sorry, we've got a short vertical spread here on ExxonMobil. And this is a scenario. And hopefully, Lakshmi, we can kind of answer this question as well. So here's a short vertical spread. And the expectation is we sold this vertical spread for $2. It's now trading for $3.07. Let's look at the chart for ExxonMobil, XOM. And our expectation was that the price of the stock was going to go down, right? We were going to see that break below that horizontal in the head and shoulders pattern. It didn't do it. Implied volatility is going down, which is working for us. But I'll tell you what, that with 23 days to go until expiration is still kind of working against us. Now, we're at the point where we could simply leave this trade alone because we still have that potential. Again, same thing. The reason why we left the CVX trade on is because we still realize there is a little bit of bearishness in this trade. And there's still a little bit of bearishness in ExxonMobil, given the fact that it's sitting at that horizontal support on that head and shoulders pattern. 23 days to go. We still have some time in this particular trade. Time decay is going to continue to work in our favor here. But let's see if we can address Lakshmi's question. Let's create an order to close this trade down when it's done the majority of the work that it can do for us. Because here's the thing. We're trying to sell this back, right? So we bought this trade to begin. I'm sorry. Did we buy it? Is it a long vertical? Hang on. No, we're selling it back. We're buying it back. We sold it to begin with. So we're going to buy this back, but we want to be able to buy this back for a percentage of that. So what if we were to buy this back at, let's say, 75 to 80% of what we paid for it, or what we were paid for it to begin with. So let's say if we were to buy this back for 40 cents or less, right? Now it's currently trading at $3. So it's got a long ways to go. But what we're going to do is we're going to right click and we're going to create a closing order, and we're going to look at buying this back, but we're going to make this a limit order to buy this vertical spread back at 40 cents or less, and we're going to make that good till canceled. So that's, Lakshmi, how you would create a take profit order of a trade that's already on as a percentage basis of max profit. We know that the max profit that we can make on this trade is the $2. So 40 cents, buying it back for 40 cents is about 80% of that max theoretical gain that we could make in the trade. So we're going to put this order on to buy this trade back and eliminate that short leg obligation. We're going to click on confirm and send. We're going to put that order out there. And this is going to sit there as a waiting order to manage this position, right? Yeah, and Terry says, yeah, single leg rule. If a trade isn't going your way when you're 7 days from expiring, cut the position to mitigate the weekend. I like that. Keep your weekends free from theta worry. So one of the things that you might do, and I just want to show this really quickly. We're almost out of time here, but I wanted to come up here to the setup tab up on the top right of the Thinkorswim platform. And if you go to application settings and you go to orders, actually, I'm sorry, you go to positions. Go to positions. Notice right here where it says mark ITM positions. And by default, this is set at the week before expiration. But if you were a trader that you like to see where that position is, maybe even a little bit longer away than that, maybe you're not as likely to hold trades into expiration, what you might do is choose 2 weeks before expiration. And that way you're going to see positions that are moving into that in the money location sooner, and maybe that jogs your memory and says, hey, that's something that I need to take care of and I need to deal with. Am I going to let it go to expiration and auto exercise? Am I going to choose to exercise it? Do I need to sell it? Do I need to manage it? So moving that from 1 week before expiration to 2 weeks before expiration, that little flag that says mark in the money positions, moving that to a longer time may give you an opportunity to have a little bit more time to deal with some of those circumstances than at other times. So if we go back to our monitor tab, you see that in the money position flag, that's going to be something that you need to deal with. Now, here's the one that I want to look at as we finish this up. This is that Nike trade. We bought that put option. Nike went down. It's got 2 days to go until expiration. We've got a pretty good profit here. We probably frittered away some of that in terms of time decay because we didn't pay attention to it. And we've let it go further and closer to expiration than we perhaps should have. It's got 2 days to go. There's not much more gain to be had here in those next 2 days. I'm going to right click. I'm going to close this down. And sometimes it's good to take a profit on a trade when you can take the profit on the trade, just like sometimes it's good to take a loss and manage that position. So guys, thanks very much for joining me for this discussion and letting me kind of walk through this process. If you haven't done so already, click on subscribe. You can come out here to the Trader Talks webcast page on YouTube, and you can search for stuff here on the Trader Talks webcast page. Here's a great one, planning exit orders on debit spreads to take profits or losses at a particular price. So guys, thanks for letting me clean out my closet with you. And my thanks to Connie Hill for helping out with me with this as well. I will see you back here in a couple hours for trading index options. We'll see you then. Take care, everybody. Bye-bye.